when we kind of look at where we came from, the warning signs had really already been there that something was, off and something was changing. What we're really seeing in the market is we have, two different things going on. Part of it is obviously the tariff news. I think the other part of it is that the market was already heading lower, and I think you're also seeing a delevering process. And so that obviously takes some time to play out. But I think the bigger story here is that the warning signs were there already. We had talked about them quite a bit. The BTIC S&P 500, futures were already warning us and telling us that the cost of funding, the cost of equity, the cost of leverage basically had already collapsed. Basically back when the Fed did the announcement on December 18th at that FOMC announcement, that marked the high. And basically we saw that the cost of leverage collapsed because obviously the demand for leverage began to show signs of cracking. This was really one of the key warning signs, at least for me, that suggested something was off, and we really weren't seeing it coming back. And more importantly is that we've also seen that this number has actually continued to decline. And so really, if kind of using this as a guide, would suggest to me that until we start seeing, the demand for leverage to start to rise again, you're probably likely going to continue to see, the equity market struggle. At least that's what history would suggest. And so this is certainly one thing you could use to, again, kind of just pay attention to what's happening out there. And basically credit spreads were extremely tight. Credit spreads were partially responsible for why financial conditions, credit spreads being tight were the reason why financial conditions were so easy. That was also the reason why you saw PE multiples expand at what rate at which they did. And so now, we're looking at the ICE AAA corporate index option adjusted spread. So this is actually for AAA debt. And what we're looking at here are basically spreads that were, basically at record type lows. When we look at the ICE high yield spread, that also was basically at or near levels not seen since 2007, also near record lows. And really more recently, we've been seeing this number begin to move up. But again, when you look at where this number is, this is where we were in October of 23. This was during SVB. This was July of 22 when we got that high CPI print, which ended up marking the ultimate high point, which began to turn lower. I mean, even at current levels, credit spreads are still fairly low. They're not really at levels that scream, something is really horrible. I think they're just kind of at levels that are really kind of where they should be, historically speaking. In fact, when you look at where, we were throughout most of 2017 and 18, credit spreads range between 324 to, basically 400 basis points. This is where we were throughout much of March and July and August and October and November of 2017. So, and, if you go back even further, here's your blue dotted line running across. I mean, this is February, you can see, credit spreads much higher over time. And so this is sort of, not really abnormal at this point. So you can almost make a case that credit spreads have just returned to some sort of historical normal range, which also kind of gives you a sense that, credit market hasn't really freaked out quite as much as the equity market has as well. And, there's obviously other signs that there's deleveraging going on because, implied correlations were very low. They were telling us that basically the individual stocks within the S&P 500 were no longer correlated to the actual index itself because these numbers had become so low. In fact, in July and August, in July, basically, this number got down to about a 2 or 3. Obviously 0 means no correlation and 1 means they're highly correlated. Right now, it kind of looks to me like we're at some sort of the middle ground, to be honest. And when you look at it on a longer term basis, again, this is just really looking like a lot of the middle ground. And so it's hard to, again, kind of conceptualize. But I think really more importantly is what it tells you is about where we were. We were at these extremes in terms of credit spreads. We were at extremes in terms of correlations. We were at extremes in terms of even volatility. When you look at the VIX, the VIX was at the lower end of the historical range going all the way back in time. So, historically, the VIX is somewhere in this, call it 14, 15, 16, 17 range. But again, we were trading, through most of January last year, June of last year, even November and December of last year, more closely to these 12 ranges, which again tend to be towards the lower end of the historical range. When you look at the VVIX, which measures implied volatility of the VIX, again, here it is in May of 24, trading all the way down here at 73. And even in November, December, we were trading at 85. So again, a lot of these metrics, what they're telling you is that the markets were, extremely complacent. And this idea that the market was just going to continue to melt higher was clearly well embedded in it. And now all of a sudden, we started to get these warning signs that the market was going to start breaking because we started to see Nvidia go. That was clearly one of the key leaders to this whole thing. I mean, semis really haven't acted well now for a very long time. The other warning is the housing sector wasn't really acting well. It actually peaked in November of 24, and you can really see that, here. Again, the housing sector, HGX tends to be a leading indicator in my experience to the S&P 500 as well. So, I mean, I guess what I'm getting at is that this was already in motion. And, maybe the tariff news has been part of it. Maybe it's part of the reason why the market's moving down. Certainly, it's accelerated it. But I think leading up to it, there were other things already happening and taking place that kind of showed us that this market was running out of steam. In fact, when you look at the RSP, which was the equal weight index, that peaked in December, and that's been acting really poorly as well. So, when you take a market that's very complacent with very high valuations, that's already beginning to show signs of leakage, it doesn't really take much to kind of really accelerate things and throw the fuel onto the fire that's really going to make it, go up go up really fast. And that's basically where we are at this point. I don't really know if this is helpful. I'm thinking that it's good to take a look back and see how we got to where we are. I think if those things, at least you can take it and learn a lesson from it to kind of keep an eye on them, because those things may also tell you when the bottom is in. And if you at least look at many of these different indicators that I was going through, they don't really suggest that there's a bottom yet. They kind of suggest we're just back to normal. And I know that's probably not settling to hear, but that's probably about where we are in this right now. So we'll just have to continue to watch things and see how they play out. Anyway, if you like this video, please remember to share it with your friends and subscribe to this channel. Take care. Bye.